Let's now look at a few problems relating to accounting standard 2. Cost of a partly finished unit at the end of 2016-17 is rupees 150. So till now we incurred 150 rupees on that partly finished unit. The unit can be finished next year by a further expenditure of rupees 100. Okay, so 250 is the total expenditure on that product. 150 already incurred plus 100 we are yet to incur. Then finished unit can be sold at 250 rupees subject to payment of 4% brokerage on selling price. So 250 is going to be the selling price, but in that we have to pay brokerage of 4%. 4% on 250 will be 10 rupees. So 10 rupees we have to pay as brokerage. So 250 minus 10, how much will we get net? We will get 240 rupees net. Alright. Then value of inventory is to be determined. How do we determine the value of inventory? Friends, we will value this at cost or net realizable value, whichever is lower. What is cost? Right now it is 150. Right, keep it aside. What is the net realizable value? Selling price of 250 minus estimated cost of completion. How much cost should we incur to complete this? 100 rupees we have to incur to complete this. Right, subtract that. Minus incidental selling expenses. What is that? 10 rupees. Subtract that also. So what will this give you? 140. So friends, basically net realizable value is 140. 150 or 140, whichever is lower. So here inventory should be valued at 140. Now let's talk about an example to understand how these overheads have to be dealt with. ABC Limited has a plant with a capacity to produce 1 lakh units of a product per annum and the expected fixed overhead is rupees 18 lakhs. Okay. So 18 lakhs of overhead and 1 lakh units is the expected production. So per unit, what is the predetermined overhead recovery rate? 18 rupees is the predetermined fixed overhead recovery rate. Okay. Fixed overhead on the basis of normal capacity is 18 lakh rupees by 1 lakh units. So that is rupees 18. Fine. Now, if the case 1, actual production is 1 lakh units, then what should we do? Nothing. So you already have the predetermined fixed overhead recovery rate of 18 rupees per unit and the actual is equal to now expected units of 1 lakh. So you can continue with the predetermined fixed overhead recovery rate whatever you assessed. Right. Now let's look at case 2. Actual production is 90,000 units. If actual production is 90,000 units, planned or normal capacity was 1 lakh, but actual is 90,000. When actual is 90,000, do we revise the predetermined fixed overhead recovery rate? No, we don't revise that. So you will continue at 18 rupees into 90,000. So that will be 16,20,000 and only this much can be considered as recovery, or basically this much portion can go into inventory. So what will happen to 10,000 units into 18 rupees? What will happen to that? That portion will remain to be charged off to P&L fully immediately. That portion will not go into inventory valuation. Now look at case 3. Actual production is 1.2. Friends, whatever we do, ultimately we should absorb the actual cost. What is the actual cost? 18 lakhs. 18 lakhs only should be absorbed. So if I apply 1.2 into 18 rupees, actually you are absorbing much more than the actual cost incurred. So that is why predetermined fixed overhead recovery rate should be revised. And how do we do the calculation then? 1.2 lakh units is the actual production, right? So revise the predetermined fixed overhead recovery rate in such a way that if you recover so much, it should be equal to 18 lakhs. So your calculation will be something like this. 18 lakhs should be recovered over 1.2 lakh units. So 18 lakhs divided by 1.2. What is that number coming to? 15 rupees. So your revised fixed overhead recovery rate is 15. Originally it was 18. Now you revised it to 15. Right. Let's look at the next question. The cost and net realizable value and inventory value of two items that a company has in its inventory are given below. Item 1, item 2. Cost, net realizable value given. For item 1, cost is 50,000, net realizable value is 45,000. Inventory should be valued at what? Lower of cost or net realizable value. So for item 1, it should be at 45,000. Item 2, 20,000, 24,000. Cost is 20, net realizable value is 24,000. So it should be valued at the lower of the two, which is 20,000. Now 45,000 for item 1 and 20,000 for 2, both put together will be 65,000. Now listen carefully, friends. One of the common mistakes what the students can do in the exam is, if you look at the total of cost for item 1 plus 2, it is 70,000. If you look at total of net realizable value for 1 and 2, it is 69,000. So if you take 70,000 or 69,000, whichever is lower, you might say 69,000. So inventory has to be at 69,000. No. That's not the way you should be looking at the inventory valuation. So we understood that if possible, item by item basis is the most appropriate one, and that's possible, that's given in the question. So go for each item, what is the cost, what is the net realizable value, based on that 45,000 plus 20,000, 65,000 should be the total of inventory value, not 69,000. Let's now look at the next question. X Company Limited purchased goods at a cost of 40 lakhs in October 2016. Till March 17, 75% of the stock were sold. Okay, so 40 lakhs purchased, 75% sold. So what is left out then? 25%. 25% of 40 lakhs is how much? 10 lakhs. So 10 lakhs is what is left out. Okay, then company wants to disclose closing stock at rupees 10 lakhs. Expected sale value is rupees 11 lakhs and a commission at 10% on sale is payable to the agent. Interesting. Selling price is 11 lakhs, but what is the commission portion? 10% on 11 lakhs. So if you reduce the 10%, that is 1.1 lakhs, you reduce, it will be 9.9 lakhs. So by selling, you will realize only 9.9 lakhs. And what is the cost? Cost is 10 lakhs. So 10 lakhs of inventory cost or 9.9, which is the net realizable value, whichever is lower. So inventory should be valued at what? It should be valued at the lower of the two, 9.9 lakhs. Next question. In a production process, normal waste is 5% of input. 5,000 metric ton of input were put in process, resulting in a wastage of 300 metric ton. Tell me one thing, if 5,000 metric ton is put in the process at 5% of normal wastage, it should have been how much? Wastage portion should have been 5% on 5,000, that is 250 metric ton. But what is the actual wastage? 300 metric ton is the actual wastage. So the normal loss or normal wastage is 250, abnormal wastage is 50. So in that 300, 250 is normal wastage, 50 is abnormal wastage. Okay, continue. Cost per metric ton of input is 1000 rupees. Entire quantity of waste is on stock at the year end. With reference to accounting standard, how will you value inventories in this case? Alright. Now, the total cost of 1000 into 5000 metric, 1000 rupees per metric ton into 5000 metric tons, that will be 50 lakh rupees. 50 lakh rupees should be the cost, not for 5000 metric tons. 50 lakh rupees, we should consider that is the cost for 5000 minus 250 metric tons, right? 4750 metric tons. Why? We know that we will have to pay for 5000, but we will get 5000 minus that 250, because we understood that 5% is the normal processing wastage, right? So that's something which we know we would have had to pay, right? So considering that, what is the normal cost per metric ton? 50 lakhs by 4750, that comes to 1052 approximately. 1052 is the normal cost per metric ton. Now, what is the question about? How will you value inventories in this case? How much of inventories are left out? Friends, 5000 we ordered, but how much? 5000 minus what is the actual wastage? Actual wastage is 300. 250 is normal, 50 is abnormal, but totally what is the wastage? 300 is the total wastage. So 4700 only we have in our stock. So inventory of 4700 into 1052 will be the valuation of inventory. So that comes to 49,47,368. And further 50 units into 1052, approximately that comes to 52,632. That portion should be charged off fully immediately to P&L. Right, let's move to the next question. You are required to value the inventory per kg of finished goods consisting of material cost 200 rupees per kg, direct labor 40 rupees per kg, direct variable overhead 20 rupees per kg. Alright. So 200 plus 40 plus 20, so 260 per kg is straightforward. Okay. Now come to the tricky portion. Fixed production charges for the year on normal working capacity of 2 lakh kgs is 20 lakhs. So 20 lakh rupees of fixed overhead we have, and we normally expect to produce how many units? 2 lakh units. So 20 lakhs by 2 lakhs, 10 rupees is the normal predetermined fixed overhead recovery rate. So that's what actually should go into the cost. So 260 we already ascertained, 200 plus 40 plus 20. Now add this 10, totally 270 will be the cost per unit.